Hello, my name is Karine Hoang. I work at OCIAM. OCIAM is a French asset management company, an affiliate of Natixis Investment Managers, and specializes in smart beta strategies. I'm here with my colleague Carmine to shed some light about minimum variance. Since 2008, financial markets have been on a strong upward trend, and investors do know how bumpy roads can be going forward. Minimum variance strategies have been designed to help investors cope with uncertain markets, but also to thrive in more favorable market conditions. Carmine, can you tell us what a minimum variance is?
Thank you, Karine. The primary objective of a minimum variance strategy is to reduce portfolio's risk while being exposed to the equity market. And one of the outcomes is to target a substantial reduction in drawdowns. We both know that this is crucial to preserve the portfolio's long-term growth.
Let's talk concrete. How does OCIAM implement minimum variance?
Risk mitigation and diversification are the two pillars of our approach. To reduce volatility, we exploit two sources: low volatility stocks and stocks that are less correlated with the market. Both academic and investors know that risk estimation is more robust than return forecasts. Therefore, our systematic approach delivers more robust outcomes.
How does minimum variance behave across market regimes?
Minimum variance is by nature a long-term strategy. Its value added is revealed when the market change conditions. For instance, over the long run, minimum variance exhibits strong convexity.
Convexity? What do you mean?
To give an example, when the market goes up, say, by 10%, on average, minimum variance will go up by something between 7 to 8%. On the contrary, during severe or extended downturn, when the market loses, say, 10%, minimum variance reduces the loss by half. So convexity is the ratio of these two numbers. High convexity means a very asymmetric profile, so you capture more on the upside than you lose on the downside.
How do you build a minimum variance portfolio?
We start from an investment universe from which we select only the most liquid stocks. We then select and weight companies according to their historical volatility and correlation under several constraints. For instance, we cap maximum exposure to a stock, to a sector, to a country eventually, and we make sure that the final portfolio has a defined level of diversification.
So how does the portfolio compare with the benchmark?
Overall, OCIAM's minimum variance strategies reduce volatility by roughly 30% compared to their benchmark. We tend to be very different from the benchmark, with large sector or country deviation, which is not the case for most of low volatility approaches. For instance, back in the summer of 2011, during the Eurozone sovereign debt crisis, our European minimum variance strategies had almost no exposure to the financial sectors. Over the long run, we expect a high tracking error, something between 5 to 6%, and the long-term alpha comes from both the allocation effect and the stock peaking effect.
To what kind of investors does minimum variance best suit?
Investors with a need of risk mitigation, they tend to include the strategy in their core portfolio. Historically, it has been mainly professional investors who consider this kind of approach.
And now?
Nowadays, the UCITS ETF format has made the strategy available to a much larger base of investors, but it is important to keep in mind that the strategies are long-term by nature, so it's more suited for strategic rather than tactical allocation. And we are also seeing more interesting in ESG version of minimum variance strategies.
Talking about ESG, how well does ESG combine with minimum variance?
Our research has shown that ESG and minimum variance complement each other very well, and this is why we have designed an ESG version of our US minimum variance strategy. Basically, it has the same financial profile of the minimum variance strategy, but a substantial improvement in its ESG performance.
But then, do you think that minimum variance is a fad, and do you see any risk of overcrowding?
Minimum variance has been around for many decades now and is upheld by strong academic research. It has a long and proven track record, so I don't think it's a fad. On the contrary, I think it's a valid tool for investors. And regarding your point about overcrowding, it is still a tiny share of the global investment, especially when we compare it with other mainstream investment styles, such as value, for example. Finally, the diversity of low volatility approaches reduce the risk of overcrowding.
In the end, what do we get in a minimum variance portfolio?
We tend to be invested in stocks in mature businesses with steady cash flow, regular dividend, stocks that are more profitable and dominant in their business, which of course makes them more suited for volatile markets.
What do you recommend to look at when selecting a minimum variance strategy?
First, always verify that the primary objectives are fulfilled: volatility reduction and drawdown mitigation. Make sure that the strategy is well diversified. Consistency across regions is also a good sign. And finally, I would recommend to assess the robustness of the strategy with respect to the parameters of the model.
Thank you for watching. Thank you, Carmine, for the clarification about minimum variance at OSIAM.